Haidi, okami waig tumi walego. Chimikoka yuwitiku kiyagi. Welcome back to the Deep Dive. We're here to cut through the market noise and get straight to the signal. Today we're doing a really critical deep dive. We're looking at PonyAI, ticker PONY. They're a major player, really a leader, in the global race for level 4 autonomous driving.
And the timing couldn't be more interesting, could it? We're recording this on November 7th, 2025.
Exactly. Just one day after their big Hong Kong dual listing.
Right. A move designed to, shore up their finances, broaden the investor base, especially getting more traction in Asia.
But, well, the market's immediate reaction, it wasn't exactly a party. The stock actually fell quite a bit.
Yeah, definitely stumbled out of the gate.
So our mission today is, let's say, nuanced. We need to look past that knee-jerk market volatility and give you, our listeners, a really balanced view. We're comparing PonyAI's internal strengths, and they are significant, like their new Gen 7 tech, their dominance in getting permits in China against, well, the external reality, which is a pretty skeptical public market right now.
There's definitely some fatigue around AI evaluations, you could say.
Absolutely.
Yeah.
So how are we tackling this? What's our source material?
We've pulled together a pretty solid stack. We've got their Q1 2025 earnings report, which gives us some pretty eye-popping growth numbers.
Okay.
Crucially, we also have analysis of what just happened with that Hong Kong IPO yesterday, November 6th. The disappointment there.
Right, the immediate reaction.
And of course, we've dug into the details of their technology. That Gen 7 system is key, plus their global partnerships. Those are really going to determine if they can actually reach profitability.
So it's that classic story, isn't it? Spending big now, burning cash, hoping for market dominance later.
It's a high-stakes bet, no question.
Okay, let's kick things off with the basics. For anyone maybe not super familiar, PonyAI isn't just making fancy cruise control. They're all in on level 4 autonomy. Can you break that down? What does L4 actually mean, and what's their core tech?
Sure. So level 4, or L4, autonomy. Basically, it means the car drives itself completely under certain conditions. Think specific geographic areas, maybe certain weather conditions.
There's not anywhere like level 5 promises.
Exactly. That's the key difference. Within its defined operational design domain, or ODD, an L4 vehicle doesn't need a human driver to intervene. It's truly driverless in that zone.
Got it.
And PonyAI's whole identity is built around developing the full software and hardware stack for this. They call it their virtual driver technology.
Virtual driver, okay.
Yeah, it's proprietary. It's end-to-end, meaning it covers everything, the software that makes decisions, the specific hardware needed, like sensors and computers, and the cloud services for support and updates.
And on the hardware side, they're not building everything from scratch, right? They've tied up with a big semiconductor player.
That's a really important point for scaling up. Their system is built on the NVIDIA D-Drive Orin chip platform.
NVIDIA. Makes sense.
Right. Using a high-performance automotive-grade chip like Orin, instead of trying to design their own custom silicon from the ground up, well, it saves a huge amount of time and money.
Gets them to market faster.
Gets them to market faster and lets them tap into NVIDIA's existing manufacturing and supply chain muscle. That's absolutely critical if they want to hit those big fleet numbers they're aiming for.
Okay, so let's look at the money. The Q1 2025 snapshot you mentioned. Where's the revenue actually coming from now versus where's the big growth potential they're chasing?
Yeah, Q1 showed total revenue of $14.0 million. But the breakdown tells a story of transition.
Okay.
The biggest chunk right now, $7.8 million, actually came from their goods transport side. That's the robo-truck services, logistics, that kind of thing. It's providing some near-term stability.
Right, the less glamorous but perhaps more stable part for now.
Precisely. Then the second piece, about $4.5 million, was from licensing and applications, mostly selling their autonomous domain controller, the ADC.
The brain of this system.
Essentially, yes. Selling that hardware to their automotive partners, the OEMs.
And then everyone talks about the robo-taxis.
That's the one with the explosive growth potential, but interestingly, it was the smallest contributor in Q1, only $1.7 million.
Only $1.7 million out of 14.
Yeah. But you have to remember that's the segment they are pouring resources into scaling up. They fully expect it to dwarf the other two segments relatively soon. And as we'll discuss, the growth rate there is already astronomical.
Okay, that sets the stage. Beyond the financials, though, you mentioned their regulatory position in China. It sounds like they've built a significant lead there.
Oh, it's more than significant. It's arguably their biggest competitive advantage right now, especially domestically. They are the only company, let me repeat that, the only one with permits to operate fully driverless, level 4 commercial robotaxi services in all 4 of China's major Tier 1 cities.
All 4. So Beijing, Shanghai, Guangzhou, and Shenzhen.
That's correct. Nobody else has managed to get that full set of permits for fully driverless commercial operation.
Yeah, that's huge. These aren't exactly quiet suburbs we're talking about. Getting permits in those incredibly complex, dense urban environments must signal enormous trust from the regulators.
It absolutely does. It speaks volumes about their demonstrated safety record and operational reliability over millions of kilometers driven.
And they hit a major milestone recently in Shenzhen, right?
They did. End of March this year, 2025. They got China's first ever citywide fully driverless commercial robotaxi license, specifically for the Nanshan district in Shenzhen.
Citywide, fully driverless commercial.
Think about what that means operationally. They are the first to be allowed to run a commercial taxi service, charging fares, without a human safety driver physically in the car across an entire major district of a Tier 1 city. That's a massive step towards making the economics work. Removing the human driver costs is the holy grail here.
Okay, so painting the picture on the ground today. How big is the fleet? How much driving have they actually done?
Scale is the name of the game for them right now. They operate a fleet of over 720 self-owned robotaxis.
720. Okay.
Plus, remember the trucks, over 170 robotrucks. And the key metric that underpins everything is the mileage. They've accumulated over 55 million kilometers of autonomous driving.
55 million kilometers.
Yeah. And all that data, all those real-world miles, feeds back into their AI models. They have something called the Pony World Foundation model to continuously improve the virtual driver. It creates this virtuous cycle, this data flywheel, that helps maintain their technological edge. Hashtag tag 3, market dynamics and scaling ambition.
Right. Let's shift focus a bit to the broader market. Pony AI isn't operating in a vacuum. They're in this global AI mobility arms race. Huge money, fierce competition.
Arms race is definitely the right term. They're going toe-to-toe with absolute giants. You've got Alphabet's Waymo, GM's Cruise.
The big U.S. players.
Right. And then very strong domestic competition in China, too, particularly Baidu's Apollo Go, and also WeRide, which just listed alongside Pony AI in Hong Kong.
And you mentioned this earlier. There's a general feeling maybe of AI valuation fatigue among investors.
I think that's fair to say. You look at the massive run-up in the big tech names, the Magnificent Seven or whatever we call them now. A lot of investors feel they already have exposure to AI and even autonomous driving through companies like Alphabet or maybe Tesla or Baidu.
So the question becomes, why invest separately in a pure-play autonomous driving company like Pony AI, especially one that's not profitable yet?
That is precisely the hurdle they face in the public markets. Investors want to see profits, or at least a very clear, very near-term path to profit, especially when they feel they can get similar exposure elsewhere with less risk. This skepticism really forms the backdrop to that disappointing Hong Kong debut we saw.
Yet, despite all that, their CEO, James Peng, declared 2025 as the year of scaling up. What's the actual plan? What are they trying to achieve this year?
It's basically a race to get big, fast, before the cash runs low. The big headline target is to grow their cell-phone robotaxi fleet to 1,000 vehicles by the end of this year, 2025.
From 720 to 1,000 in, the remaining months? That's ambitious.
It is. And it's not just about the number of cars. It's about proving they can manufacture, deploy, and operate this advanced Gen 7 technology reliably and efficiently at scale.
And you need the operating area to support that many vehicles.
Absolutely. They've already got a commercialized operational domain. The areas where they can actually offer rides spanning over 2,000 square kilometers.
2,000?
Yeah, across those 4 main Chinese Tier 1 cities. Just for context, if you're listening in the U.S., think about San Francisco. Their operating area is almost 20 times the size of the entire city of San Francisco.
Wow. Okay, that puts it in perspective. That huge permitted area is what allows them to even think about deploying 1,000 cars effectively.
It's the essential foundation for turning scale into revenue.
And this ambition isn't just limited to China, right? They're pushing outwards globally.
Definitely. They're actively looking for markets that have kind of the right conditions. Strong demand for mobility solutions, good infrastructure, and importantly, governments that are open to autonomous driving.
Where have we seen concrete steps recently?
Well, earlier this year, back in Q1, we saw some significant moves. They secured an L4 robotaxi testing permit in Luxembourg.
Luxembourg. Interesting choice.
It's actually a key regulatory hub in Europe for mobility tech. Getting that permit is a big step for European validation. And at the same time, they started road testing in South Korea, specifically in Seoul's Gangnam district.
High-profile, complex, urban environments again.
Exactly. These aren't easy places to drive, human or otherwise. They serve as great proving grounds for the technology outside China.
And they're using partnerships to get a foothold in these markets.
Yes, that's key to their strategy. Avoids having to build everything from scratch. The alliance with Uber is a major one.
Right, you mentioned that. Starting in the Middle East.
Yes, initially focusing on deploying their robotaxis integrated onto the Uber platform in places like Dubai. That gives them instant access to Uber's huge customer base.
Smart. Leveraging existing networks.
And in Southeast Asia, they're working with Comfort Delgro, a massive transport company there, on a pilot robotaxi program in Singapore. So it's a multi-pronged approach. China dominance, strategic tests in Europe and Korea, and platform partnerships in the Middle East and Southeast Asia.
Okay, now let's really dig into the positive side of the ledger. If we try to tune out the noise from this week's stock performance, that Q1 2025 report had some numbers that seemed to back up management's confidence. Let's get into that explosive growth.
Yeah, the growth figures are, frankly, hard to ignore. Overall revenue was up 11.6% year over year, reaching $14.0 million. But like we hinted before, that top-line number hides the real action.
Which is in the robotaxi segment.
Exactly. Revenue specifically from robotaxi services, it jumped by an incredible 200.3% compared to Q1 last year.
Wow, 200% growth year on year for that specific segment.
Triple the revenue from robotaxis in just 12 months. And maybe even more importantly for proving the commercial model.
The actual fares they're collecting?
Bingo, the fare charging revenue. This is the metric that shows people are actually paying to use the service, that it's moving beyond just testing. That revenue stream grew by approximately 800% year over year.
800%. Okay, that's not just growth, that's hypergrowth.
It really is. And it's not just because they added a few more cars. It reflects them optimizing the service, expanding the areas where the public can hail and pay for rides across those 4 big cities. Customers are clearly adopting it at an accelerating pace.
But usually, in this industry, that kind of rapid expansion comes with absolutely crushing costs. Which brings us to their Gen 7 system. This seems to be positioned as the game changer, the thing that makes the economics work.
That's precisely it. The Gen 7 system is ponieAI's answer to the profitability puzzle. It wasn't just a minor upgrade. They fundamentally re-engineered it with cost reduction as a primary goal.
And the headline figure is pretty dramatic.
It really is. They managed to slash the bill of materials, cost the BOM, basically the cost of all the parts needed to build the self-driving kit,
Right.
by a massive 70% compared to their previous Gen 6 system.
70% cheaper to build each unit. That's not incremental improvement. That sounds transformative. How on earth did they achieve that kind of saving?
It comes down to tackling the most expensive components head-on through better integration and, likely, better deals with suppliers as they scale. 2 main areas stand out.
Okay.
First, they cut the cost of the main autonomous driving computing unit by 80%. 80%.
The core computer brain.
Exactly. Leveraging that NVIDIA Orin platform efficiently and optimizing how all the sensors feed into it. Second, they achieved a 68% reduction in the cost of the LiDAR sensors.
And LiDAR has always been notoriously expensive.
Historically, yes. LiDAR and the high-power compute unit were the 2 biggest cost drivers for L4 systems. Cutting those specific costs by 2/3 or more fundamentally alters the path to profitability.
So this Gen 7 isn't just better tech, it's cheaper tech. And that allows the CEO to talk about having a clear line of sight to breaking even.
That's the connection. It shifts the whole narrative. It's not about if they can ever afford to run these services profitably, but when they can deploy enough of these cheaper Gen 7 units to hit the necessary scale and volume.
And the cost savings aren't just on the hardware side, are they? They're also making strides in operational efficiency, specifically around labor costs.
Yeah, this is another crucial piece. Running these fleets, especially early on, involves remote monitoring and potentially remote assistance if a vehicle gets stuck or confused. That requires people, which costs money.
Right.
But ponieAI, likely because of the maturity and reliability shown over those 55 million kilometers, has managed to achieve what seems to be an industry-leading ratio here. They can have one remote assistant monitoring up to 20 vehicles simultaneously.
20 to 1. That sounds very efficient compared to what you hear elsewhere.
It does. If competitors are closer to, say, 5.1 or maybe 10.1, PonyAI is realizing significant savings on operational labor costs. It drastically lowers the ongoing operating expenditure, the OPEX.
And there's one more operational cost saving linked directly to their safety record: insurance.
Absolutely. Because their systems have proven to be safe, demonstrably safer than human drivers in many cases. Based on accident data, their commercial insurance premiums are about half the cost of insuring a traditional taxi fleet run by humans.
So the tech advantage directly lowers both the capital cost, cheaper Gen 7 hardware, and the operating cost. Fewer remote staff, lower insurance.
You've got it. It's a compounding effect.
Okay, so with all this positive momentum internally, the massive revenue growth, the dramatic cost cuts, the operational efficiencies, what's the vibe from Wall Street analysts who follow the company? Ignoring the IPO blip for a second.
Well, looking at the underlying fundamentals, the analyst consensus is still generally positive, or at least cautiously optimistic. Based on ratings from 9 analysts recently, the consensus is a moderate buy.
Moderate buy.
They give it a score of 2.89 out of 4, and their average price target is $19.40 per share.
And where was it trading just before the Hong Kong listing?
It was around $14.82 as of November 6th. So that consensus target implies a potential upside of, roughly 31%.
So analysts see upside based on these factors.
They seem to be buying into management's narrative, particularly that target of hitting a key profit milestone by early 2026. They see the Gen 7 economics as the credible path to get there.
All right, that lays out a pretty compelling bull case, but we have to square that with reality. The public market's reaction this week in Hong Kong was, well, rough.
Understatement of the year, perhaps.
Let's confront that paradox. If the tech is great, the growth is explosive, the costs are coming down, why did the stock tank right after the dual listing?
Yeah, this is where the internal confidence slams into external skepticism. That Hong Kong debut on November 6th, it was a clear disappointment. The shares dropped over 12% in early trading.
Ouch. Even after raising a significant amount of money.
Even after successfully raising HK $6.71 billion, which is about $860 million US dollars, that's fresh capital, but the market basically said, we're still not convinced about the price.
And it wasn't just PonyAI having a bad day, right? Their competitor WeRide also listed and struggled.
That's right. WeRide fell nearly 8% on its debut, too. It suggests it wasn't just a PonyAI-specific issue, but maybe broader market sentiment towards the sector right now.
The CEO, James Peng, tried to explain it away, pointing to volatility in the U.S. markets and liquidity issues.
Which is, a standard thing CEOs say in these situations, but it likely doesn't capture the whole picture. There seem to be deeper worries about valuation and timing.
What do you mean by timing?
When a company like this, in a hot sector like AI and autonomy, goes public or does a major listing, investors want to see momentum, they want conviction. Seeing both PonyAI and WeRide stumble suggests the market just isn't ready to embrace these valuations right now. The profitability timeline feels too uncertain for many.
Okay, let's peel back the onion on the financials again. That 800% fair charging growth is exciting, yes, but it costs a lot of money to achieve. And that's showing up in their losses.
Absolutely. This is the trade-off, the cash burn reality. PonyAI is spending heavily to achieve that scale. In Q1 2025, their net loss widened quite dramatically. It hit $37.4 million.
Compared to what the year before?
Compared to $20.8 million loss in Q1 of 2024. So the loss nearly doubled year over year.
Nearly double the loss, even with revenue growing. Where did all that extra spending go?
It's almost entirely tied to getting ready for mass production of the Gen 7 system. Research and development expenses soared. They were up nearly 60% year over year, hitting $47.5 million just in Q1.
$47 million just on R&D in one quarter.
Yes. That covers finalizing the Gen 7 design for manufacturing, setting up the supply chains, testing, validation, and there were also some one-time costs related to share awards linked to the IPO. But the core driver is that big push to get Gen 7 vehicles built and deployed.
And that kind of spending eats into their cash reserves, obviously. How's their runway looking?
That's the critical point. Their cash and equivalents dropped from about $825 million at the end of last year, December 2024, down to $738.5 million by the end of March 2025. So they burned through roughly $87 million in the quarter.
Okay, $87 million burn in Q1. Slightly different from the net loss due to non-cash items, I guess, but still a big number.
It's a significant burn rate. Now, the $860 million they just raised in Hong Kong, obviously refills the tank substantially.
Right, that buys them more time.
It buys them time, yes. But the weak market reaction shows that investors are now saying, okay, you have the money, now show us the path to profit works. We're done with promises. Based on the pre-IPO burn rate, analysts were estimating maybe 6 to 8 quarters of runway before things got tight without the new funds.
So that early 2026 profit target isn't just aspirational, it feels more like a necessity now.
It feels like a very firm deadline, yes. They likely need to show significant progress towards break-even well before that cash cushion gets thin again. Otherwise, going back to the market for more money could be painful.
Which brings us back to that broader investor skepticism. You mentioned AI fatigue, but some analysts were quoted saying this offering was maybe 6 months too late or a year too early. What's behind that timing critique?
A couple of things. One is that feeling of overrepresentation we talked about. Investors think, I can get my autonomous driving exposure via Alphabet or Baidu. Why take a flyer on a pure play? Second, there's the regulatory reality. Getting permission for fully driverless operation everywhere is hard and slow. Safety incidents, even minor ones, can cause setbacks. Politics plays a role.
So the tech might be ready before the regulations allow widespread deployment.
That's often the case. And that regulatory lag makes investors nervous about putting high valuations on companies today because the path to generating massive revenue might be slower than the tech roadmap suggests.
We saw this valuation tension play out even before Hong Kong, didn't we? With their original NASDAQ Q IPO.
We absolutely did. Back in November 2024, when they listed on NASDAQ Q, the IPO priced the company significantly lower, almost $3 billion lower than its last private funding round valuation.
Which was what, Series D?
Yeah, their Series D valued them at $8.5 billion. The public market basically said, nope, not worth that much yet. Venture capital firms might pay for future potential, but public markets demand a clearer path to actual earnings.
So that 70% cost cut from Gen 7. The market sees that less as a bonus and more as something that was necessary just to justify even the reduced public valuation.
I think that's a fair interpretation. It highlights this fundamental disconnect between the optimism needed to fund R&D heavy tech in private markets and the financial discipline demanded by public investors.
So the bottom line from the negative side is, great tech, great growth potential, but the market needs proof of sustainable profit. And the high cash burn combined with regulatory uncertainty makes them hesitant to pay a premium right now.
That sums it up well. The weak Hong Kong debut just hammered that message home. Management is under intense pressure now to deliver on the financial promises of Gen 7 and fast. #tag V size, strategic alliances, and resilience.
Okay, so despite that pressure cooker environment financially, poniAI isn't hitting the brakes operationally. You mentioned partnerships are key to their execution strategy, especially for actually building the cars.
Absolutely. Hitting that 1,000 vehicle target by year end would be incredibly expensive if they had to build their own factories. So they rely heavily on alliances with established automakers, original equipment manufacturers, or OEMs.
Who are they working with?
Their key partners for mass production of the Gen 7 robotaxis are Toyota,
Okay, big one.
and major Chinese manufacturers BAIC and GAC. Essentially, poniAI provides the brains, the virtual driver software, the sensors, the ADC computer.
And the OEMs provide the car bodies and the assembly lines.
Exactly. It leverages the manufacturing scale and expertise of the automakers, ensuring quality control and hopefully speeding up deployment. It's a symbiotic relationship.
And then on the other side, getting customers into these cars, they're integrating with existing platforms rather than trying to build their own ride-hailing app from scratch.
Yeah, another smart move to conserve cash and gain access quickly. We already talked about the Uber partnership for the Middle East.
Right, instant access to Uber users.
That's huge market penetration right there.
Yeah.
And domestically in China, the partnership with Tencent is arguably even more critical.
How does that work?
They're integrating poniAI's robotaxi service directly into Tencent's Weixin mobility services, that's WeChat, essentially, and also into Tencent Maps.
So users can hail a poniAI car right from within WeChat, which everyone in China uses constantly.
Pretty much. It taps into an absolutely massive existing user base. It's unparalleled distribution within China, far quicker than trying to build brand awareness on their own.
And you mentioned Singapore, too.
Yes, the pilot program there is with ComfortDelGro, which is one of the largest taxi and transport operators in that region.
Yeah.
Again, leveraging an established players' network and reputation.
Okay, one last piece here. Geopolitics. We're in late 2025, U.S.-China trade tensions are still a factor. How vulnerable is ponieAI to tariffs or supply chain issues related to that?
They've addressed this directly, saying the impact of potential tariffs is minimal.
Minimal. How can they be so confident?
Two main reasons they cite. First, they've deliberately sourced the majority of the components for the Gen 7 system from within China. A domestic supply chain insulates them significantly.
Yeah, okay, that makes sense.
Second, they've apparently been proactive in diversifying suppliers even within China and building up inventory buffers for key components. It's about building resilience into the supply chain.
So the CFO is saying they're still on track for that 1,000 vehicle target this year, regardless of trade winds.
That's the official line, yes. It signals they believe their operational plan is robust enough to withstand the current geopolitical climate. #tags a 7 outro.
All right, let's try and synthesize all of this. We've taken a deep dive into ponieAI, and it really feels like a company living two lives right now.
It's definitely a tale of two narratives, isn't it?
On the one hand, you have truly impressive internal progress. Phenomenal technology, the regulatory coup in China getting those 4 Tier 1 cities, that mind-blowing 800% growth in fair revenue, and crucially, the Gen 7 system promising that massive 70% cost reduction.
Yeah, the potential for efficient scaling seems very real based on those internal metrics and technological achievements.
But then on the other hand, you have this collision with external market reality. The Hong Kong debut was undeniably weak, the cash burn is substantial, leading to widening losses, and there's this broader skepticism in the public markets about AI valuations, and specifically, how long it will really take for autonomous driving to become a profitable business at scale.
It really is a high-wire act. They've built the efficient machine, the Gen 7 system, that could make profit possible.
But now they have to execute. They have to get those cars built, deployed, and operating efficiently enough to significantly reduce that cash burn. And they need to do it before that $860 million cushion starts to look thin again.
It really boils down to a race against time and against market sentiment. Can they turn that operational efficiency into bottom-line results fast enough to win back investor confidence?
So maybe the final thought for you, our listeners, to chew on is this. ponieAI's future seems to hang in this balance. It's not just about having the best tech or the most driving miles anymore.
Right. It's about whether their proven ability to cut costs, that 70% BEBOM reduction, that 20.1 remote assistance ratio, can translate into actual verifiable profitability quickly enough to overcome the current wave of investor doubt. Can operational reality bridge the gap to market acceptance before the financial pressure becomes overwhelming? That's the critical question for ponieAI heading into 2026.
A fascinating challenge indeed. We'll certainly be watching closely. 장주리와 감사합니다. 조세타죠.
앞으로도 알고 싶은 기업이 있다면 댓글로 남겨주세요.